Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another great episode of We Build Great Apartment Communities, the only place where you come to learn how to take apartment buildings and turn them into amazing communities. I am your host, John Brackett. Welcome to the show today. We have another great guest. His name is Denis Shapiro. This is going to be kind of a unique show, folks, in that we're going to talk about affordable housing from the viewpoint of government agency housing, and then what that looks like when that housing becomes available as it starts to near its term, through some of the agencies, right? So we're going to get into that topic today, and I'm really excited about this topic because I think there are many times or instances where you hear about affordable housing, and the barriers to get involved in that space can be fairly high. But what a lot of people don't realize is there's a tail attached to that, or deed restrictions rather. And so once those deed restrictions come off, you have some more possibilities with that product type. And today we're going to get into that. So here's ultimately what it should do. It should open up another possibility or an avenue for you to explore another purchase avenue, right? Happy to get into this conversation today with Denis Shapiro. So Denis, welcome to the show, man.
Hey, John, thanks for having me. I'm really excited to be here.
Okay, sounds great. Okay, hey, bud, so give us a quick summary of your background, and then we're going to get right into this.
Sure. 20 years ago, my oldest brother gave me a copy of Rich Dad Poor Dad. I bought my first stock. After that, I've been trading stocks for the last 20 years. Throughout that 20 years, I found it's really easy to have my portfolio appreciate really well, especially if I don't trade during the downturns. But the one thing I couldn't get out of my stock portfolio was the income side. I tried every income strategy, the utilities, the REITs, the MLPs, all those strategies failed miserably because the same thing kept happening because the stock market is completely liquid. It's also completely volatile, and it only takes 1 or 2 down days for all the yield that you've earned for the year or two to completely dissipate. So the last 10 years or so, I started looking for that solution. I got into real estate. The first house I ever bought was actually a low-income housing, but it was a one-off property in a low-income area. It was a terrible experience. Never wanted to scale that. From there, I went super passive. I started doing note funds, ATM funds, apartment building syndications. And then when I really got into syndications, that's when the light bulb flipped. I did a whole bunch of deals as a limited partner, started my investment club, and then from then started doing more GP deals. So I didn't just go to like a boot camp and just started GPing. I went the way of investing in the deals first, seeing the different variables that make a deal successful or not. Then I finally found a partner of mine who specializes in affordable housing. And coincidentally, I probably wouldn't be in the space if it wasn't for him, but that was his specialty. And the more I started learning, the more I started liking about what affordable housing can actually bring to an investor.
Okay, beautiful, man. So let's get right into that because I think that's really a great segue. Well, first of all, talk a little bit about the affordable housing strategy that we're going to discuss now, right? Because there are a lot of, I don't want to say misnomers, but when people hear the word affordable housing, I think a lot of things come to mind. So in this particular case, we're going to talk about a very specific product type, right? And this is more of an agency product type. So talk a little bit about this, man. Elaborate on what this actually is, what affordable housing actually is, at least in this particular case. And then we're going to kind of fast forward.
Yeah, so I'll give a high-level overview of affordable housing. So the problem is today, and it's been the same way for a couple of decades now, the cost to build a new property is so expensive, but a lot of the costs are sunk in to developmental rights and foundation and all the electric. So when you get to the final product, there's not much for these developers to do to make it a high-end product. And there's incentive for them to get that higher end product because the higher end product will command the higher rents. So the way the government kind of incentivizes these developers to build for the lower income, middle income class is by giving these tax credits. So that's why a lot of these affordable housing deals, you hear them as LIHTC deals, low income tax housing credits. And these credits are they last for about 30 years. But the point of these credits is to incentivize and lower the cost to construct affordable housing through the country. It's the biggest incentive there is. And it's probably the only reason why developers are still developing affordable housing versus just building Class A all over the place. The developer gets these tax credits, then these buildings go up, and then there's two 15-year periods. During the second 15-year period, that's where it gets interesting. That's where operators such as myself, they'll come in. They won't buy it in the first 15-year period, but the second 15-year period allows for a lot of opportunity, because what happens is at the end of that second 15-year period, the income restrictions come off, and then it becomes a regular market rent deal. So we're buying a deal. So what our last deal we bought is we had 6 years left for the restriction to fall off. So we're buying this property with a very small buyer pool, because the buyers don't want to deal with the regulations. You got to be state approved, county approved, different audits. It's a much more complicated business model and a much more complicated process to acquiring than your run-of-the-mill value-add property that you see all over the place. So you have a small buyer pool, but once an income restriction actually falls off, then you get the regular buyer pool, because anybody can come in at that point. They don't need no regulation. They don't need no state certifications, anything like that. But just because the natural transition of the buyer pool actually increasing, the value of the property goes up considerably. Just an interesting note on the last property, there was two different appraisals we got. We purchased the property for 5.7. It was appraised at 6.4, but in the same appraisal, they actually said at the time the income restriction falls off, the property will actually be 8.4. So it was interesting to actually see a value for that income restriction actually falling off.
Yeah, we'll get into this a little bit more, but was that decline in value based on the rents being restricted or the limited buyer pool? A combination of both. I think very difficult to quantify a buyer pool, but much easier to quantify that value based off of, in this case, deed restricted rents versus market rents, right?
Yeah, I definitely lend it more towards the buyer pool situation, because what happens is this specific seller that we're dealing with, they're one of the largest developers in the state, and they've had multiple transactions fail at the last moment because a certification did not come in. The county did not feel good about approving them for the transaction, versus my partner's already been approved by the state and county, has those relationships where that's off the table, that uncertainty of, is this deal actually going to happen? And what happens is, because that uncertainty is there in the developer's mind, he's not going to go to a regular broker and list it and getting a bidding war, because that goes against what they want. They want a closed transaction because they're in the business of developing. So by them going for the top dollar that you see today in these bidding wars, that doesn't guarantee them a sale at the end of the day. So they would rather keep it off market, give it to their buyers that they know have already been able to execute, already have the certifications, already know the process, and maybe take a little bit less, but at the same time have that certainty from the day one.
So how are they quantifying a value based on limited demand? I mean, that's a subjective value.
Sure. The deal that we had, they had a broker's value of opinion on it, but they never listed it with it. So the deal that I think we got for 5.7, I think the broker had between 5.8 and 6.4 is realistic range. So it's not like they're turning around and they're being like, I don't know, non-professional about it. They are in the range of what that property should sell at. It's not like we're coming in and buying it 50 cents on the dollar. The other big thing is developers tend to be really good developers, and they leave a lot of meat on the bones when it comes to operating. So for example, the deal that we're buying, the operating expenses were close to 76%. So, they knew some of those expenses are, I would say, a little overinflated, but at the same time, even if it was a market deal, it would be hard for them to get a bidding war with operating expenses that high.
Okay, cool. So let's pivot a little bit and talk about the operating strategy, right? So I appreciate the summary, great summary on what low income housing actually is. In this case, with the tax credits, right? So talk about the number one strategy that you're looking to employ with this particular asset.
And I did want to clarify, because I know I gave a high level thing of low income housing, but just a vision wise, because when people think low income housing, they think of housing authority. They think of what they see in like movies and TVs, like where, it's a high crime area. It's in one area. The properties that we're looking at, since they were built with the LIHTC credits, they are less than 30 years old. And they would look like a Class B asset. So they're not like what some people would say, like a Class D type of asset. This is a really nice condo townhouse with 2 parking spaces per person. There's dishwashers, there's washer and dryers in the unit. It's just geared to people that have a certain income restriction. So it's great for families that are making $30,000, $40,000, and they can get a whole townhouse for $1,100, $1,200, $1,300 a month. So that's the vision I want people to see. I don't want them visualizing a high crime area. These are really beautiful communities. And right. Even in the property that we're buying, in the back of that property, there's actually a horse farm. I always joke with my partner, I was like, oh, great, we got a free amenity because our tenants could just go outside and, see beautiful horses just roaming around. So that was the first misnomer that I really wanted to get out there is people need to, I've had investors walk our property and they said they would not in a million years think this was affordable housing when they were on the property. And they had children's playgrounds and everything like that. So I did want to get into that. So then the second part, I think your question was the business plan and how is it different with affordable housing? I don't want to generalize this across every single affordable housing deal because a lot of that is going to depend on where you are in that income restriction period phasing off.
Right.
But in the situation that we're in, we're going in and the T12 has certain line items that we know are really high. So they are a big developer, but they also have their own property management LLC. Their property management LLC charging the apartment building LLC close to 9 to 10% for property management. That's double for that size of property. But for them, it makes sense from a bookkeeping perspective. And, that's all I'll say about that. But that's something where day one, we can go in and we could bring down. We actually did. We already have it at 4.5%, a more normalized rate for a larger property. The second thing is a lot of low-income tax housing developers, they make this misnomer where just because they built this property in the 1990s, they don't feel like they need to update certain things throughout the life of that property because it's such a new property, right? Versus if you're buying something 1970s vintage, you're going to come in there with a heavy CapEx. But in this situation, we walk around and all the toilets water efficient in 1998. They're not water efficient today. So we go in there and we replace every single toilet, the shower heads, the aerators, so the water bills, the insurance. Believe it or not, we were able to actually go through the same broker as the seller. And by us just partitioning it off from a portfolio, blanket insurance policy, we were able to save like 30% just from that. So there were all these little line items where the focus isn't really the income, because on the income side, they're actually doing really good. They were 98% occupied. I think between the 6 months that we had this thing on the PSA, we went from 98 to 100. So this thing here is not to come in and kick out the tenants and start renovating. That's the furthest thing away from it. The thing here is to come in, keep the occupancy where it's at, and bring down those operating expenses for where they should be for a 1998 property, such as the water bills, such as the insurance. And the other thing is great with affordable housing is you get access to the waiting list from the counties, but they were still paying, apartments.com charge of $5,000 a year. So there are all these things that kind of didn't make sense, but we've done it in the past and we were able to stop day one, slowly implement. It's a very different pace for an investor that's used to looking at these value add deals where the whole focus is basically on the income side, where we come in and it's really about the expenses.
Okay, so this is really an expense reduction play. So what is the margin that you create in this case from reducing the expenses? So you said right now you're operating at about a 70%, right, operating expense ratio, right? And
yes.
So what do you think you can reduce that to?
76 to like in the low 50s.
Okay,
so
cool.
it's going to be like 24, 25%. Yeah.
So you increase it by 20%. That's pretty good. I mean, there's definitely some room there to play with that makes pursuing something like this worth the investment, right? Okay, cool, man. So now let's talk about, since we talked about that and you did a great job of clarifying which expenses you felt you had the greatest opportunities to reduce. And it sounds like there's really an aggregate of expenses, which makes it even better, right? A basket of expense reduction opportunities to create a 20% margin. And there you go, right? You have an investment that makes it worth your time and energy. Now, here's what's really interesting, man. When you start executing on an operating plan to reduce expenses, it requires a different set of focus because, to your point, In many cases, a property manager, their oversight with expenses gets sheltered by, these rent bumps, right? So if you're going from, a deed restricted property and all of a sudden now you're doubling rents, your ability to manage down expenses can get, overshadowed, right? So
Yeah.
talk to us a little bit about the property management company that you have in place, and how do you create the expectation or hire the right company, in this case, to be able to execute on a massive expense reduction play. This is probably like a 3-year strategy, especially with all the utility, requirements.
We actually expect everything. We've done a similar project my partner has, and he's done it in 12 months. So the big strategy here is we're using the same property management that we had for our previous property. And our property manager on that company, on that property, is actually GPing the deal with us. So he's going to be overseeing the current property manager that's on place. So one of the biggest strategies with any multifamily is if you have a good experience with one property manager, make sure you bring them on to the second property. So the other umbrella question would be the property management selection. So this specific property management company, they're out of Pennsylvania. They have like 38,000 units. But the most important thing is that they have a special division for affordable housing. So you do not want regular property management here that does not have a special division, because it is a very different regulatory environment. We have 4 different voucher programs on site, and each voucher program has their own regulations and rent regulations. So every single thing is an extra layer of bureaucracy. Again, that's part of the barrier of entry. But at the same time, so we are only dealing with one very specific property manager. They have a special division. And on top of that, we brought on our previous property managers as a general partner to oversee the management aspect of it.
Okay, so here's something I'm really curious about, right? In this case, the property management company that is managing this asset, they have, some very good experience managing this type of product, right? Affordable housing, so they're familiar with the regulations, the inspection requirements, man, can create a bunch of hassles and problems. But what does the expectation look like right now? I know that might not be where you're involved in, because you said there's a GP managing that, but how are they setting expectations? Probably their KPIs look a little bit different than what a traditional multifamily asset would. What does that look like? Because I think there's some pretty good insight into that, right? Because you're managing to a different set of requirements, but you still have to manage to something.
Yeah. So we bring them on very early on. They were on board from week 1, and they basically fact checked our underwriting. And we did it where, they sent us our own underwriting on what they think the line items should look like. The line items are the line items. It's the same T12 you'll see in any multifamily. Here's more the vouchers and the complications there. So we did work with them really early on these line items, where they thought we were being aggressive, where we didn't. And then we had the third fact check is that we had the management company, and then we had the property manager who's going to come on the GP, go through every single line item. And, we kind of averaged out where they kind of lied, but everybody was pretty close. That is one good thing, is both my partners have affordable housing backgrounds. So they know exactly where we could push. The good thing is also in affordable housing, a lot of times the utilities are actually on the tenants, or they get a utility allowance. So that actually, then we only really have to pay for the common charges and stuff like that, which again makes you incredibly interesting how they run a 76% operating expenses in that situation. Those are strategies we employ, really get the property management on board. So we're not saying hey, this thing should run at 50, and then they're turning around and saying, well, it should be running at 62. We find that middle ground, and then we set the goals based on that middle ground.
Right. Okay. Awesome, man. Awesome. So where do you go from here, right? Do you continue to stay in this little niche, or do you expand out of this and create another complement to what you're doing now?
Yeah, so my company, SIH Capital, we do some other stuff, like we have an income fund, and we do some joint ventures with our investor list as well. But our primary focus going forward is definitely going to be the affordable housing syndications. We just think that it's one of the rare niches in real estate that actually has a legitimate barrier of entry. And that's just becoming more and more attractive to me as I see other deals. Like I don't even look at broker deals anymore just because we have that relationship with the seller. We're not going through middleman. The seller's already indicated that he's willing to give us a bigger project after this, where we could actually go and just tour 2-3 different properties and actually just put the bids on where we have it. Like you don't get those type of relationships these days when you go into a broker. So I think we're just going to get a bigger footprint in the affordable housing space. That's our goal at this point.
Awesome, man. Hey, bud. Well, we're winding down our time right now, but I want to thank you for being on. I think this was a really good summary of affordable housing product, in this case, this particular product type. And I just want to thank you for being on and just, sharing your experiences and the strategy, right, that most employ when, you're taking on an affordable housing product. It's really not income strategy because of the restrictions, but rather an expense reduction strategy. So I want to thank you for kind of rounding that off. And my question to you now is, what is a question that you have for me, since I've been asking you questions for the last 30 minutes, for almost 40, that you feel can add some value to our audience?
How's the multifamily project in the background going?
Oh, it's going really well, man. This particular property is in downtown Houston, actually, or very near downtown. I did an exchange into this one. Really, it's a great location, older product though, beautiful building, brick building. And so, right now, when we bought this, I spent a bunch of time, we demoed out most of the units at this point and opened up some walls just to see what was behind the walls. And there was some plumbing upgrades that we had to make. And I was expecting that, right, with an older building. And then we also changed some of the floor plans around. So all of our rough plumbing is almost done. We dropped a bunch of new electrical lines because we're building in washer and dryers. So all that stuff is plumbed out now. And I think maybe with the exception of 5 more units. And so things are going really well. And my hope is that in 2 weeks, we'll have everything shelled out, right? All the drywall back on, textured, vendor suppliers getting great deals on cabinets, countertops, backsplash, all the tile. Just got a great deal on some appliances from Home Depot, their corporate group, and pretty good. Things are going well. I think next week we should have all of our, and new windows, man. Got a great deal on Anderson windows. I couldn't believe it. I'm like, geez, this is incredible.
Nice. It sounds like a full gut.
Well, I guess it is. It is predominantly just because of the plumbing upgrades that we had to do. And there's gas in the building, right? So we're using gas with the washer dryer and then gas with the range of the stove. And, we kept those 2 items, but initially I wanted to convert everything over to electric, but we had some restrictions, man, with some of our electric panels. So we had to drop gas for the laundry, and it's stackable. It should be a great project. I think we're tracking pretty well on this thing. We should start speeding up though this month once we close out the walls and shell everything out. That's when the fun begins, right? That's when everything starts to come alive.
Yeah, that's when the way they start the HGTV shows, right?
Exactly right.
The 90% of the work, they don't show.
Yeah, so of course now all the subs are getting excited because everything's being shelled out. Right, that's where everybody likes doing their piece. So I'm actually hiring on a couple more people just to speed things up a little bit. So it should be a really good product, man. I'm really excited about it, and it's going to really add a lot of value to the community too. So very, very excited about that.
Love it. So it's completely vacant right now.
It's not completely vacant. It's, I want to say about 80% vacant right now. We still have some folks that have been here for 20 years, man. And they're like, we're going to wait until this thing is finished. And then we're going to apply for the new units. I'm like, okay, hey, that's great. Not a problem. Not a problem.
Yeah. Awesome, man.
Pays for our carrying costs. And I'm like, hey, that's good. Sometimes better to be lucky than good, man.
Yeah, no, I got you, man. Well, congrats. I'm looking forward to seeing the progress on that one.
So yeah, once everything's done, we'll have a package, and I don't think I'll post this, but yeah, if you want to check it out, happy to share it, man. Not a problem.
Gotta post it, man.
I might. Well, hey, man, really great to have you on. Thanks so much for the question. Want to wish you continued success, and also want to welcome you to the We Build Great Apartment Communities family of amazing investors. Anything I can do to help, further your journey, man, happy to definitely try. If I can't do it, I can connect you with a lot of people I'm sure that can.
I appreciate it, man.
Yeah, you're very welcome, man. Have a good one. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.